Hello and welcome to the Can I Retire Now podcast with your hosts, Nick Russell and Becky Wagoner. I'm your podcast producer, RJ Malik. Nick and Becky, as always, good to see you, and I hope all is well. And Nick, you're in control today, the way you like it. It's all about you today, isn't it?
It's about
all
time.
about Nick.
It's about time. So today's topic, we're calling the episode "Retirement and Investing Cheat Codes."
Mm-hmm.
Kind of stem from, I think, a problem, I guess, a little complaint, old man, grudge I have against society now, where everything's immediate gratification.
Right.
I want an answer right now. I want to be
Right.
satisfied, and that's not really how investing works. Best laid plans, especially long-term retirement planning, education planning for kids, you get a benefit of investing over time. And so there isn't this magic, hey, I'm going to invest in something today, make a ton of money, and next week I'm going to do something else. But there are a few what I like to call cheat codes.
Okay.
Isn't that a video game lingo?
Yeah,
Cheat
it kind of
codes?
comes from my upbringing as a video game
Okay.
nerd.
All right.
Yeah.
I have a different story about cheat codes.
Oh,
Oh,
okay.
gosh.
Not
Does
video
it?
game related?
It's not video game related.
Okay.
What
When
do you
I
got?
was a teenager, I believe it was my sophomore year of high school. I was a terrible kid, and I was getting into trouble, and I was awful in school, and I ended up having to go to summer school, which
Oh.
drove my parents crazy. So while I'm in
Okay.
summer school, I was passing everything. Actually, I was acing everything. In fact, the teacher came to me one day and he says, "Why are you here? You should not be here. These kids, they're just not up to speed, and I'm not surprised they're here, but why are you here?" And I was, I didn't say anything about it. But there was this one kid who I befriended, and we got along, and I knew he wasn't the swiftest, and I wanted to help him. So I developed a code for him so he could cheat off of me. So during the
How
test,
giving of you. Okay.
yes, I thought I was being a nice guy.
You're getting this kid
So
through
dur-
summer school. Okay.
Yeah, during the test, I came up with signs, and the kid was acing everything, and the teacher knew we were cheating, but he couldn't figure out how.
No.
To the point, yeah, he couldn't figure it
What
out.
were these hand signals?
Yes.
Coughs? Like what was
It
happening?
was
Okay.
it was the position of my pencil. If I
Wow.
That's
pointed
clever.
it forward, yeah. So that's how we figured it out. That's how we communicated, and he was acing everything, and the teacher knew it. And the teacher came to me, and he threatened. He threatened me. He said, "I don't know how you're doing it, but I know you're cheating, and it's driving me crazy. And I'm so tempted to just beat the crap out of you."
What?
And
Oh, the good old days. You
yeah,
can beat
and
a student. Yeah.
And the thing is, what made it worse, because I was, a teenager, I had attitude. I was giving him attitude at the same time. So
Oh, no.
I totally understood why he was angry with me, because that's what I was trying to do. I was a miserable jerk at the time.
And you
So
were just making everyone else miserable.
exactly.
So
Let me take
did you
a
stop
moment. Oh,
the cheat code though? Did you stop after he threatened you, or did you keep it up
No,
just to be
no, I
contrary?
kept.
Yeah.
Oh yeah, I kept it up.
Okay. Good. Good.
yeah, that's on the teacher to
Consistency.
figure that out, right?
I
Yeah.
wanted to be consistent, and I wanted to
Yeah.
help out my fellow student.
Nothing but a good friend. Okay.
Okay.
So if I can interject and
great.
say that we don't promote cheating in school,
Or
your
in
opinions
investments.
and actions, do not
Right.
reflect the opinions of the
Right.
host and the podcast and
I
all
look
that,
back on
but-
that, and I regret my actions. I do. I sincerely
I'm just
regret my
imagining you, by the way, RJ, in high school with like a mohawk dyed blue or something, like a
No,
real troublemaker. Just yeah.
no. I went to an all-boys Catholic high school, so I had to wear
Oh.
a tie.
Oh
and-
wow.
Yeah. Oh yeah. And I couldn't
Well
grow
then, they
no
really
facial
gave
hair.
you
or
reason
anything.
to act out. Then, I mean, come on.
Pro-
what else were your
pro-
options?
Probably, but I was a teen. I was like 15 years old.
Yeah, then
I was
that's
a
just the way.
Becky
teenagers
doesn't
are.
understand. She was an amazing teenager, super well behaved.
I'm not
Perfect.
surprised.
Yeah,
Check
and
with
she's-
my parents.
she doesn't even
she's a-
understand what you're saying. It's,
Well, and you two are an amazing couple, so I mean, I'm not surprised.
Well, that's sweet. That's sweet.
well,
but
we should save an episode for all the things Becky did in high school. that compare with you cheating. Yeah, I was the good kid, believe it or not. People
Oh,
No,
were
I
never.
was
you?
good too. I was very good. But
I was
anyway,
not.
let's.
I was not good. If my dad was still around, he could tell you stories, and
Oh boy.
yeah, I was the typical uh, obnoxious teenager. I really was not good. It wasn't until I graduated from college that I realized and was out in the real world that I realized what a jerk I was. And
Oh,
I actually called my dad and I apologized and I told him that,
wow.
I said, now I understand. I understand why you're doing everything, and I'm sorry that I was such a jerk. And he was like, that's fine, So it's good
Well,
stuff.
you turned out to be an amazing gentleman here. So,
Uh,
and we're gonna just bring you back to your roots with the little cheat codes,
yes,
apparently,
please do.
from Nick.
Yeah. Subtle
So,
transition. That was a nice segue, babe. Very
uh,
nice. Very
bring it
nice. Bring
back.
it back
Okay.
on topic. Okay. So, so this kind of started, and I've kind of accumulated these over time, and none of which I've created, but I've kind of picked up over the years. And I always think of this, like if RJ, if you and I didn't know each other, and let's say back in my single days where you might find me out at a bar and we're sitting next to each other, and you find out what I do for a living, 90% of the time, people ask me, what would you invest in today? Or how do you know I'm on track or not to retirement? And so I always think of like, what would I scribble on a cocktail napkin? And so there's three rules or three cheat codes, if you will, that I've come across over the years that I think are great napkin scratch. Hey, am I doing the right thing or am I on track? So those are what I wanted to
Okay.
cover today. They won't help
This
you ace a class in school, but they
Yeah.
hopefully get you to retirement.
Okay, so
So
this is good if you're setting
yeah,
your goals for the new year. You want to just make sure
yeah,
you're on track. It doesn't replace having a professional, but if you're a DIYer here, maybe.
yeah.
Okay,
If you're looking
all
for
right.
some information and get to make sure you're doing okay without reaching out to somebody. First one, it's called the Rule of 72. Okay.
Oh,
I
intriguing.
get I get tell by the look on both of your faces. Never heard of Rule of 72. That's okay.
All
All
right.
right. So Rule of 72 states that if you have a lump sum of money, so I
Mm-hmm.
say lump sum. This is not if you're making contributions like in a 401k, just a lump sum of money. If you can earn 10%, your
Mm-hmm.
money will double every 7.2 years. You just move the decimal into 72. The
Well,
nice thing
it should
is,
be the rule of 7.2 then, not 72. Just saying. Okay,
so I
I'm
didn't
sorry.
create the rule, and fine. We'll
These
remarket this.
finance people
The,
need some
the,
marketing
the
people
rule is
because.
7.2. It just
Okay.
rolls off the tongue.
Okay.
Um, so if you have a lump sum of money, let's say you're 40 years old and you have
Mm-hmm.
$100,000,
Okay.
um, then if you can earn, and the market S&P 500 averages a little over 10% every rolling 10 years. So 10% is a pretty
Oh.
reasonable number to use.
Okay.
Your money will double every 7.2 years. So let's just call it 7 years. So
Mm-hmm.
if I was 40 and I had $100,000,
Mm-hmm.
at 47 it would be 200,000. At 54 it would be 400,000. At 54 and 7 is 61. At 61 it would be 800,000, and at
Mm,
68
Wow.
it would be 1.6 million.
wow.
So if you
So
could
you
do
just gotta let
nothing,
it ride.
let it go. And if you can earn those returns predictably, which I'm not going to say is easy, but let's say you do it, just
Mm-hmm.
average market returns without any contributions, your money would naturally double every 7 years. Now, a fun aspect to that is you can flip it. Let's say you're not as growth oriented or you're not as aggressive as an investor. If you can earn 7.2%, your money will double every 10 years. You just flip
Oh,
the numbers.
nice.
Math is
It's like
fun.
percentages are reversible too. I know
Math
that.
is
Okay.
fun. So
All
again, if I
right.
was at 40, if I can earn 7%, my 100,000 would be 200,000 at 50, 400,000 at 60, 800,000 at 70. Um, so
Okay.
very easy way to figure out that if you have a chunk of money, what you could reasonably
Mm-hmm.
grow to over time. Now, as a reminder, and I mentioned it briefly, if let's
Mm-hmm.
say you're looking at your current balance in your 401k, you're also making contributions. You're also potentially getting a match from the company. So your money should double even
More
faster than
frequent.
that. Correct.
Oh, okay. Because we're starting, assuming we have a lump sum already in it. So it,
Correct.
even if we didn't add any more, would double, but since we're adding regularly.
You
Okay,
should
so that's
you
a,
should speed that along. Yeah.
okay, so you can kind of project where you will be given the money you have now. All things go like they normally go, kind
I
of
mean,
thing.
based on at least those two numbers, 10% and 7.2. And obviously
Okay.
today there's a million online calculators and all
Yeah.
that. But that was a really impressive trick before smartphones. If you could just sit there and go, well, if you have this much, okay, you'd have that much. And people were very
Oh,
impressed.
that's okay.
And now you just jump
Smarty
on
pants.
Google and you're like, yeah, everybody can do that, Nick. But if you're sitting here listening to this and you go, hey, I have X amount of dollars. If I do nothing else, like what can I expect in 20 years? If you're earning 10% or 7%, you can kind of figure out
Okay.
what
I
that is.
like
Yeah.
that. The
Yeah.
rule of
Rule of
72.
we're going to call it rule of 72 because that's
I
what it's
know.
been
Well,
called forever.
7.2 times. It kind of works. I'm on board. I'm on board. All right.
Okay.
Okay.
All right. So first one's good. First good cheat code, right?
Yes.
All right. So that cheat code really works while you're accumulating. The second cheat code is really for when you're taking income. So now maybe you're in retirement
Okay.
or you're close to it and you're starting to try to figure out, am I going to be able to draw income or how much income can I draw?
Mm-hmm.
And this is called the 4% rule.
So many
No,
percentages.
I
Okay.
was no
No,
decimal
yeah.
points though, so you should be
Oh,
happy.
just the
4%
4% rule.
rule.
Okay.
And this states that if you are 65 years old today, that
Mm-hmm.
if your investments can earn at least 5%, you can withdraw 4% from your accounts every year, never worry about running out of money, and you'll be able to increase it every year for inflation. So,
Oh, well, yeah. Okay. You're making 5%. You withdraw 4%. There's a little bit
okay.
left in there to grow and to cover inflation. Okay. I get it.
Yeah.
I
No,
get
no,
it.
that's how most people think. And they go, well, if you're making 5 and taking 4, of course you're not
I
going
mean,
to run
that
out of
math.
money.
Yeah.
But the problem is, as you earn 5 and take out 4 the first year, the second
Mm-hmm.
year, we know because of inflation, we're going to have to take out more than 4%. You know, that number is going up, or the dollar amount that we're going to need. So if
Oh.
let's say you hit retirement, you have $1 million, 4% is 40,000, right? So let's say we can get that million to earn 5% for life. Well, the first year you make 50,000, you make your 5%, and you take out
Mm-hmm.
40, your 4%. Obviously, you have more money. But the very next year, you're going to need more than 40,000 to keep up with inflation. So you wind up taking out more and more and more. Your account should keep growing for the first chunk of years, maybe for 7 or 10 years. Then it
But it should
plateaus.
level. Yeah.
Then it starts coming down because then the amount that you need to be the inflation adjusted
Yeah.
40%
Mm-hmm.
is
Mm-hmm.
more than what you're earning. And as your account balances start to go down, it's definitely more than you're earning. And that's okay because based on mortality tables, it should last you at least 30 years, get you to like 95.
There's so many numbers. Okay.
So
The 4% rule is actually to earn 5.
you want to earn 5, which is after your fees, it's considered like a moderate risk
Okay.
tolerance. But if you can earn 5, you can always take out 4. When people come to me and they go, hey, I want to retire next year, I have $1 million. How much can I take out of my accounts and not worry about running out of money? Napkin scratch. I could say 4%,
4%.
tack on Social Security, pensions, other income that you have. There's your income. You know, it's not a perfect
That's,
science, but again, napkin scratch.
but that's a real quick method. Okay. I like that one. That one makes
Yeah,
sense.
it's
Yeah,
a
I know
good guide.
Yeah, I know you thought like my card tricks and parlor tricks and stuff were good when you went to used to hang out
Guy's
with me at
all
the bar.
flash and
But this
dazzle,
is
isn't
what I
he?
had before you. It was just math. I was spitting math with people. So
Wow. I'm
I
good
know,
thing I caught you in all
I
that
know.
math.
Yeah,
Ooh, okay.
I was just beating women off with a stick before you came around with all my math knowledge. Yeah, you know.
Wow.
Yeah, lucky you.
Lucky
Um,
me.
all right,
Okay.
so we have rule of 72 for accumulation, the 4% rule for distributions and income,
Okay.
and then um, we have kind of a formula that I it's been around for a long time. I actually disagree with slightly, and I think it needs to be updated. And it doesn't really, to my knowledge, have a name. So we're going to
Oh.
call it
So let's talk about this rule you disagree with that's
Yeah.
nameless. Let's
So
let's
so we're
do
going to talk
this.
about the
Okay.
rule, and then we're going to rename it something else with a number, like the 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 Nick age rule. I don't know. We'll think of something
Oh,
really
yeah,
creative.
yeah, we gotta
Um,
workshop that. Okay.
so yeah, I should have sent that to you in an email prior to recording.
Yeah.
Um, so we'll call it the Becky rule. So the Becky rule states that for asset allocation, so how should I be invested? Now this is high level, right? This is just considering stocks versus bonds, right? How
Okay.
much of my portfolio should be stocks, should be equities, right? Should be the growth oriented, volatile part of the portfolio versus bonds, which are a little more stable, a little lower returning part of the portfolio. So the
Okay.
rule always
Stocks,
stated,
bonds. Got it.
correct. You take 100 and subtract your age. So let's say you are 40 years old. 100 minus 40 says you should have 60% of your portfolio in stock. And then the remainder, your age, is how much you should have in bonds.
Oh, well,
I'm gonna
that's
let
real
that
simple.
I'm gonna let that sink in. Now, the issue I have with that
Hmm.
is as the investment world has become more complex and adjusted, that products are out that either have downside protection or produce higher rates of income than a traditional, 1980s stock bond portfolio.
Hmm.
Um, I personally feel that that number's out of date and that it could really be more like 90 minus your age, or even as much as 80 minus your age,
So what is
depending on those other um, aspects of your financial plan.
okay? As
So
long as you okay. So you think it should be a lower number minus your age. So if it was 80 minus 40, you think it should be 40% in stocks and then
Oh,
what in
no,
bond?
sorry, I said that wrong. Thank you.
Okay.
okay.
All
Yeah,
right.
yeah, sorry.
Oh,
It,
back up. Try again here. Okay.
my mistake. A higher number. Sorry, it should be a higher number.
Okay.
That way you wind up with a higher percentage of stocks and equities. My
But
mistake.
So
over 100%? Okay, yeah, go ahead,
Yeah,
RJ.
so let's say it's like 120. We'll just use 120 minus your age, minus 40 gives you 80% stock, right? And then
Mm-hmm.
20% bonds.
so in essence, as you get older, you should put more into stocks and less
More
into
into
bonds.
more into bonds, less
More into
into
bond.
stocks.
Okay. All right.
Yeah.
I just want to
So
make that straight.
yeah. So I can tell I explained that poorly. So
This one
it's
doesn't
because this
roll
one
off
doesn't
the
have a
tongue
name.
as easy here.
Yeah. So let's say we'll just use the number 120. And I think
Right.
this is where an update is needed, but there isn't like a really clean way to do it. It's also why I listed this one third because it's not as like easy and cool as the other two.
Okay.
Um, but let's say we took the number 120 and we picked, Becky at 40, right?
Mm-hmm.
41, but let's say 40. 120 minus 40 should give you the amount of equities, the amount of stock she should have in our portfolio. 120 minus 40 gives her 80.
Okay.
80% of her portfolio should be stocks, leaving 20% for bonds and fixed incomes.
Okay.
And the reason that makes sense to me is that in the old formula with 100, someone Becky's age or my age would have like 60% stock and 40% bonds. That's like a moderate risk
Yeah,
tolerance.
it's not as aggressive as you
It's not
probably
as
need to
growth
be.
oriented. Yeah, and the way fixed incomes have performed over the last 15 or 20 years has really not been as attractive, and stocks have been far more attractive. And I don't want recency bias here, but again, if we're using stocks, but stocks that are downside protected,
Mm-hmm.
or instead of bonds, we're using some type of product that produces a predictable income and maybe doesn't have the same kind of risk, well, all of a sudden, we could take more risk with the other part of our portfolio and get more growth, keep up with inflation. So I do think there's an adjustment there. Maybe it's 110, maybe it's 120. But if you think about it, if you're a 70-year-old,
Mm-hmm.
in retirement taking income,
Mm-hmm.
and you said even 120 minus 70 says you should have 50% in stock, leaving 50% in bonds. And to
And
me,
that's typical?
that's fine. Yeah,
Okay.
that's fine. Now, it might not be the most growth oriented stocks. Well, we probably have some of those, but we're probably going to have a lot of dividend producing stocks, things that are a little more stable. And again, you're going to have 50% of the portfolio targeting something more stable. I, I honestly think that is a preferred allocation
Mm-hmm.
for most people. But obviously it's particular to the person. I have 40-year-old clients who are very conservative. They don't want 80% of their portfolio in
Yeah, I
stock.
mean, yeah, it's
I have a client in his 80s who can't believe I invest in fixed income for him. Like he just wants all stock all the time. And
Really?
I'm
Wow.
like, buddy, it's not always going to be rainbows and butterflies. I have to protect you.
yeah.
And so this again is kind of like just hey, let's say you're 30 years old, you're sitting there, you're listening to this and you go, how much of my 401k should be stock? I could argue 100%, but if you don't want to go 100%, 120 minus 30 says 90. 90% should be stock, throw 10% in bonds or fixed income, you're going to be good.
Okay. That's good. Well, come up. All the names I'm coming up with in my head are already taken, like AAA, you know,
For
age-based asset allocation,
age-based
AAA.
asset allocation. Ooh,
Wow.
that's
Yeah.
almost
Wow.
ABBA. We could have done like a
Yeah.
Mamma Mia
Yeah, ABBA's
thing.
already taken. I've already gotten
Yeah.
there. And then I had ARF and ALF and none of it's really working. We'll keep it going though. But
Okay.
basically
We'll
this
name
one
it.
is base minimum though. Your recommendation, even if we kept it at 100, would kind of the initial
That would be
one.
like the minimum
The
amount of stock.
minimum amount,
Yeah,
okay, is your 100 minus your age
correct. Is the
between
amount of
stocks and
percentage of
bonds.
stock you should have in your portfolio, and then the remainder should be bonds. And I think a more
Okay.
modern view of it would be like 120 minus your
Okay.
age.
Okay.
Yeah. But obviously
Just
consult your financial advisor, your risk tolerance,
Yeah, yeah,
matters and
yeah.
all of that. Do you have a question, OJ?
no, I don't. No,
Okay.
I was going to, but then I was like, nah, that question's not good.
Okay.
So these
Yeah,
are
keep
good
the
rules.
bad questions out of
And
here.
these
Um,
are quick, these are really quick and easy ways, like you said, if I met you at a bar or wherever and I was like, you got any words of wisdom? Like those would be really good takeaways.
marry
And so
me.
Yeah.
That would have been my
you're
word of wisdom for
taken.
you. No, to you. If you
Oh,
have
oh,
met
yeah,
me at
yeah,
the
yeah.
bar, I would tell you to marry me. Yeah.
Oh, well,
Okay.
that's sweet. That's sweet.
It's very easy to understand, and it's very common
Mm-hmm.
sense.
Yeah,
Yeah.
because investing is complicated, right? And doing long-term planning is complicated. Everybody's life changes, everybody's situation's different. So there really isn't a lot of times I can get up in front of a group of people and say, this is the case for everybody.
Right.
But
Mm-hmm.
these can get you like 80, 85, 90% of the way there, right?
Yeah.
Just having an
Mm-hmm.
idea like, oh, if I do the rule of 72 a few times until I'm 65, that's not going to be enough money. And then you
Mm-hmm.
can say, well,
Mm-hmm.
I have to start saving more money. And then you can start now and let it grow. And that at least gets you that first step.
Oh, I thought I
Very.
had a name. Omar. I was,
Omar,
Omar?
but I think it's Amar. Age minus. No, no, no. Assets or something minus age recommendation. So, oh, 100. That was Omar. 100. O minus M
minus age.
age recommendation. It's the Omar.
Omar, the Omar
Yeah.
rule. You heard it
There
here
you
first,
go.
folks. By the way, RJ, you just got to experience
What
what
it's like
I deal
living
with
with me.
every day. Her brain, the whole time I was explaining this, she was like half listening, I don't want
Right.
to say typical wife,
Right.
but half listening to me. And then her
Mm-hmm.
brain was just figuring stuff out. She came up with like 8 different names that she didn't like. And now we
Right.
have the Omar rule.
Okay. Well, good job,
There it is.
Becky.
Yeah, yeah.
So those are my cheat codes. Rule of 72, 4% rule, the Omar
Oh,
rule,
Omar. Okay.
and Omar.
You
Heard
got
it
it.
here first. All
Yeah.
right.
So those are our
So
cheat codes. You have any questions? Anything to add, Becky?
no, since I had absolutely no idea what these rules were, I didn't know how to research a fun fact about this because I didn't want to spoil it by
Are we
looking up what
not going
any
to
of
have
these
a
were.
fun fact? Is that
No,
what's
I
happening?
brought. No, 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 no. I did not show up empty-handed.
All right. What do we got?
Okay. So I just thought it would be interesting to look up because I thought maybe one of these had to do with recommended age of retirement, and obviously I was completely wrong now that we've discussed it. Um, but still, anyway, so I looked up historical data on how old Americans are when they retire and how that has changed over time. Obviously, super interesting topic for everybody here. But anyway, this was interesting. So, between men and women, this is from 1962 until present. I'm going to ask you, do you think the average age of retirement for a man has gone up or down? And then we'll ask the same thing about women. So, what was it in 1962, and is it higher or lower now?
I'm going to let you go first, RJ.
I've looked at the notes, so I cheated.
RJ, why?
This all about cheating.
Man, you really didn't grow out of that, did you?
I didn't.
I think I know this just as an occupational hazard. I'm guessing it's later. Men are retiring later.
Incorrect. According to
Did you say
this-
incorrect?
That
Yeah,
is correct. It's
for men.
incorrect.
Yeah. According to the Center for Retirement Research at Boston College, in 1962, the average age a man retired was 66.
Okay.
And now it went down a little bit and then back up, and now it's 64.7. It's actually
That's
gone down.
That surprised me when I was looking at your notes. I was like, because I'm thinking a lot of people, especially since more people are working in jobs that are not physically demanding, that you would work longer.
You mix
Yeah.
that with less jobs have pensions.
And
So
living longer.
financially speaking,
and living
you
longer,
would
right.
work longer. You're living longer. So it's not like, hey, I'm 67 and I'm going to kick the bucket in 3 years. Like,
Right.
you might work a little longer. Though it's interesting. I had I call it a seminar, but a class I taught years ago that actually did talk about that people were planning to work longer, but wound up retiring earlier because whether they got laid off or whether they just got tired of working, or they said, yeah, I was supposed to work to this age, but I've had enough. And they just, whether they have the
Yeah.
finances for it or not, they make that decision. So, okay.
So
That's
I don't
interesting.
I don't know the reasoning. This is real, just data from Boston
Yeah.
College. So I can't say that they're wrong, but it is counter to what we think that the average age of retirement for men has actually crept down a year. So
Okay. But for women, I have to get this right. It's
Okay.
got to be later. They're retiring later. And my
Mhm.
thought is more women are in the workforce today than it was 60 years ago. So it's got to be later just by default.
Yes, that is accurate.
In
So
there.
again, I don't have the
50%.
explanation, but I would think yes, more women are in the workforce than in 1962, and I would argue, there's more independent women. Not everyone is married to their spouse, and so therefore you have to work maybe longer to accumulate the wealth needed to retire. So those are my guesses. So in 1962, the retirement age for a woman was 53, arguably pretty young, right? And now it is 62. So it's gone up 10 years.
Oh, you know what's really exciting about that? So that means
What?
we're going to be doing this podcast for at least 20 years so that you can retire at the.
And be
Did you
average?
just roll your eye? Did you roll your eyes at me?
No, dear.
I was going to
Come on.
say,
We're all
I
having
would-
fun here. It's going to be you,
I-
me, and RJ for another
Right.
20 years.
but I wouldn't classify that as exciting. I would say
I love this.
interesting.
I
or,
love this. Yeah.
But exciting.
This is
yeah.
great. Well, that's actually that's pretty interesting. But so average age of retiree being 64 and change for men, 62 for women. You know what stands out to me there? Neither one is Medicare age of 65. So now
Right.
healthcare is a very expensive thing in our
Oh.
society, and neither one is full retirement age for Social Security. The women are barely at minimum retirement age for
Right,
Social Security
right.
benefits. That creates all kinds of issues.
Well,
and I know it's an
you should-
average, but
You should take it up with the Center for Retirement Research, where this data came from. I don't know. So
when we 10 years from now, when we're still doing this, I bet
obviously,
you that will change. That people will be retiring later on both men
Later.
and women.
yeah,
Okay.
yeah. I think
well,
so.
I would have guessed that the last 60 years, but I was wrong for men. But my estimate, I think even less people with pensions, maybe Social Security doesn't keep up with inflation. There's a need for more savings, need for more income. I'd have to side with you, RJ. I'd have to think it'd be higher.
Yeah, I
But
don't know.
interesting
Maybe there's
fun
more
fact.
people saving separately from work because there's no pensions. People have their own way to earn income after retirement through their own
You'd like to think.
investments. But
You'd like to think.
okay, I'm wrong there. All right.
Yeah.
All
I
right.
think now still like 90% of people's retirement assets are in their 401ks or 401ks from a previous employer. Yeah. People have to
Okay.
save more. So
Very good.
interesting fact. So what did we learn today? We learned a couple of cheat codes. So it's like learning a fun magic trick. Now, when you're out with your friends, you can spit some fun math cheat codes and rule of 72 for accumulators, 4% rule for income, and what we just dubbed today the Omar
Yeah.
rule
Well, you
for
could just say,
asset allocation.
do you know Omar?
Do you know Omar?
I do. Yeah.
Wow. That's like one of those, like that's going to be the caption on the YouTube video is, do you know Omar, with your face like, holding your chin. Yeah. There you
Yeah,
go. That's
okay. Perfect.
that'll catch everybody's attention.
Excellent.
Yeah.
So yeah.
Very good.
Excellent. We have any homework for anybody?
I would say just to go home and do all these formulas and then compare to what you're currently doing and see if you feel like you're on track or maybe want to make any adjustments. So,
Yeah,
just
scribble
some
it
real
down.
light math over the
Just-
weekend.
It's the holiday season. By the time this comes out, might be the new year-ish. What's
Nothing
better
says
than doing some math?
season's
Right.
greetings like percentages.
Nice. Wow.
All right. Very good. Nick, how can we get in touch with you?
I just want to say I kind of felt the virtual hook like they used to give to the comedians that they need to get them off stage. RJ's like, okay, that's enough, Becky, and we're rolling out. So they can find us on the website, RJ, sunrisewealthadvisors.com, Sunrise Wealth Advisors, and we're on social media: LinkedIn, X, Facebook. The podcast, obviously, Apple Music, Spotify. We have links on our website. If anybody has questions, needs anything, or wants more information about what they hear, just feel free to reach out, and we're happy to help.
Excellent. Thank you. And we look forward to your next podcast. And thank you for listening to today's Can I Retire Now podcast. Until next time, for Nick and Becky, I'm RJ Malik.